And I'm guessing the roads are filled with traffic. But Mir, thanks for taking this call. And what do you think of this? Not just the reaction, Mir, but the follow-on action that could happen because of a tariff war. It's not something that we've seen in a long time.
Hi, good morning. You're right, Neeraj. These are unique circumstances, and there are first order, second order, third order implications which will be difficult to fathom. But in general, I would say that it might be a obvious thing. People have said it so many times that India will be amongst the least impacted countries in the world as far as the tariff situation is concerned. And second is that if you see structurally, again, today is not a good day to sound very positive. But the point is that 70% of the equity allocation of global portfolios is in the US at all-time high. The weightages of US markets in the world were at all-time highs, almost 70%. And obviously, they've shot themselves in the foot. So there will be a shift away from US to the rest of the world. In fact, in the last few months itself, we saw that Europe was hitting 52-week highs, the European markets, after a long time. You saw some money flowing into China after the Chinese tech situation. So even if, a little bit of global money starts getting pulled out from the US into the rest of the world, then India as a small market will be an obvious choice, first of all, because of our insulation towards exports. And we don't really need that much of allocation because we are relatively a small market. So even a $10-20 billion shift towards India can mean a lot for our market. So I'm not too worried in the long term. The long-term story will not change.
Right, Mir, long-term story will not change. That's right. But let's look at two aspects over here, because from a retail perspective, a crisis is a crisis. Earlier, the crisis that we saw back then in terms of the taper tantrums as well as Lehman, markets in terms of emerging markets, they were impacted by the capital outflows as well as the currency depreciation. Now you're talking about trade flows, investments, and as well as the potential inflation impact. How would you defer the outcome in terms of the three crises that we are comparing right now, and in turn the action of the investors?
This is a diametrically opposite situation compared to 2008, I would say, in a lot of ways. In 2008, when there was a crisis, people would turn to the US dollar for safety. The people would turn to the US for safety. This time is the other way around. That time, the inflation problem was in other markets. Here we are going to face a deflation problem, and the US will face an inflation problem. So we are in a diametrically opposite situation to 2008. That's why I'm saying I'm not too worried, with India being among the least impacted markets for exports.
Amir, hi, morning, Alex here. I'm just wondering how your own fund house is setting its strategy, because globally you have so many voices that are saying that we're not certain about how things are going to go, but at least as you pointed out, there is relative certainty in terms of certain pockets of strength in the Indian economy. So would you be deviating more towards the India-focused businesses and companies?
Certainly. In fact, I've said it so many times, and the portfolio also shows that. We've also discussed it so many times, that our call anyway has been that, related to the rest of the world, the domestic economy will do better. So India, obviously, before this crisis, was expected to grow at 6.5% GDP growth rate for the next couple of years, which was anyway much better than the rest of the world. We are anyway not exposed that much to the export situation, except for IT exports. So our dependence on the global situation is less. In fact, with the commodities crashing and oil prices crashing, it's actually a bonus for us. So we've always been more positive on the domestic consumptions as well as the domestic cyclicals, and we've always been negative on large cap IT, especially because we thought that they are single-digit growth rate stocks in any ways because of the long-term earnings trajectory that we saw. And in the last few days, we anyway had reduced a bit more on that. So in terms of positioning, we are very much domestically focused, obviously, but when the market crashes and, beta doesn't work, obviously it doesn't work. But we scanned the portfolio again and again, in the last 3 days, we've been doing nothing but that. But there's nothing that we really believe that we should sell based on fundamentals. There might be pockets of overvaluation, but it's more for valuation rather than fundamentals. So we are that way quite domestically focused in our portfolios. But when the market crashes, obviously everything goes down.
In a situation where the boat is rocked, Mihir, and you are obviously handling small retail money, and you've seen consistent flows, but at the same time over the last few months there has been a little bit of a question mark on the durability of, or not durability, but at least on the SIP front you have more money going out than coming in, and the first time that we've seen those kind of net negative inflows into SIPs, right? So do you think that the industry as a whole will be able to manage comfortably the kind of redemption pressure that could come through? Is that something that you're anticipating?
I don't know why you guys keep raking up this issue of redemption pressure. In the worst of the crisis, we've not seen redemption. We've faced so many crises as an industry, as a market. So I think the question is less relevant, far less relevant now, because we have seen cycles and there have never been panic redemptions in the market. We've seen that so many times now. But SEBI has also, SEBI norms of liquidity of the portfolio, etc., are also being observed and all that. So for the equities, I don't really see a problem, frankly. Our market is quite liquid.
Right. So, Mihir, taking the liquidity into consideration, the crisis into consideration, and your focus to the domestic market, we were talking to Parag Bhai, he's saying, again, cement could be a sector we should be watching out for. Which other sectors do you think would be the ones that could probably make money, taking valuations are cheap, and if you have money on the sidelines, could be deployed at current levels?
Certainly. So I think Indian financials are, amongst the safest in the world, especially the large banks and large NBFCs. And valuations had corrected in any case over the last couple of years, so as a relative basis. So that's one big safe pocket that I see as a local investor, or even as a global investor, if I were to see. It's a very good pocket. My also sense is that if this crisis, really rolls out and becomes worse, then we'll be back to government-led stimuli. Government and central bank-led stimuli over the world. So we'll see lower interest rates faster than expected. You may see a flood of liquidity again being created by central banks, and you will see again government coming into the fiscal stimulus mode, so to say. So I think all those tools which were used and which can be used for fighting a shock, external shock, so to say, the playbook will come into play, and so to the extent you might also want to see, exposure to domestic cyclicals like the government spending linked segments in infra, etc., which are high beta, so they're going to get, they're going to go down a bit more than the rest of the market because of the beta, but that's when the opportunities get created.
Okay, Mihir, and what if the Fed forces the RBI's hand to stay pat and not go ahead with a cut because of the global uncertainty? Now, I think everybody's baking in a rate cut from the RBI next week or this week, right? If that were not to happen, is that an added negative for risk assets? Part one of my question is that. Part two is, can the uncertainty drag the markets much lower than long-term average valuations? Everybody's talking about 18 times and we are already there. Why should we be there only at 18 times? Why can't we go to 17 or 16 times in these uncertain times?
We could. Everything is possible. But again, why would the RBI go hawkish in a situation where inflation is not our problem? As I repeat, the inflation problem is going to happen in the US because of tariffs. We are not the ones imposing tariffs. We are the ones who are proposing to cut tariffs. So the inflation problem, if at all it happens, will be in the US, not in India. And in India, obviously we have kept liquidity tight for so long, and we are just beginning to ease the liquidity situation. So it would be too premature to kind of talk about any kind of change in that stance. Plus, the dollar is anyway weakening. So let's not, I repeat myself, this is not 2008 kind of situation. It is reverse. Here you are talking about the dollar weakening, not strengthening.
Got it. Mihir, appreciate this. I mean, this is sane advice. Just that the markets seem to be insane currently, and therefore you can't take away the fact that there is a reaction that is very, very sharp. Thanks so much for joining in, Mihir. Really appreciate your time today.
Always a pleasure. Thank you.
By the way, guys, wonder, just pull up trend. Did I see a 15% downtick on it? Individual stocks, a lot could happen. 15% for Trent. That's a really sharp one. I don't think Trent has seen a 15% downtick in a really, really long time. We'll get those data points outgoing. Tata Steel is down 10% if I'm not wrong. A clutch of other, I want to see what Persistent is up to, was down 10% on open. I think recovered a little bit. Is it still down? Okay, no, 5.5. So some of the IT stocks, I wonder if Infi, TCS, etc., because that's a bucket that had fallen quite a bit already. It's kind of showing some bounce from the lows, but that might only be from the lows, if you will, still down about 4.5%, 5%. So looking slightly wobbly. Look at that list. Thank you for pulling that up. Coforge, Infi, HCL, everything gone. Okay. Now,